Welcome to a new video where we analyze the markets in a visual and simple way. Today, we will focus on a key indicator to understand market valuation: the price-to-book ratio of the S&P 500. From the image displayed on the screen, we have created a dynamic chart that shows its evolution from 1990 to today. The most striking aspect is that this indicator has reached historic highs, levels we haven't seen since key moments in market history. Does this mean we are on the verge of a major correction? Let's analyze it in detail. It is important to understand how this indicator has behaved in different economic cycles and what factors have driven its growth or declines in the past. This will help us gain a clearer perspective on what might come next in financial markets. We will also explore the broader implications of this valuation metric and how it compares with other historical bubbles and periods of high investor optimism. The price-to-book ratio is a metric used to assess whether the market is expensive or cheap relative to the book value of companies. It is calculated by dividing the price of a stock by its book value per share. Historically, when the price-to-book ratio of the S&P 500 has reached high levels, the market has faced significant corrections. This does not mean a crash is imminent, but it does indicate that the market is trading at a high premium compared to its actual book value. It is important to note that the price-to-book ratio varies depending on the market composition in each period. In recent years, large tech companies have inflated this metric due to their ability to generate high profit margins, partially distorting the indicator compared to previous decades. In addition, some analysts argue that the traditional interpretation of the price-to-book ratio is evolving. Many modern companies, particularly in the technology sector, have a significant portion of their value tied to intangible assets such as intellectual property, software, and brand equity. These assets are not always reflected in book value calculations, making it challenging to compare today's market with past decades. Let's examine how it has behaved over time and what we can learn from its evolution. If we look at the dynamic chart, we can see that the highest peaks in the price-to-book ratio of the S&P 500 have coincided with critical moments in the market. Dot-com bubble, 1999 to 2001. In 2000, the price-to-book ratio reached extremely high levels due to speculation in tech stocks. What followed was a nearly 50% market drop over the next 2 years. Global financial crisis, 2008 to 2009. In 2007, before the crisis, this indicator was also at elevated levels. Then, with the collapse of Lehman Brothers and the global recession, the S&P 500 lost more than 50% of its value. Post-COVID recovery, 2020 to 2021. After the initial drop in March 2020, massive stimulus packages and low interest rates pushed the price-to-book ratio to record levels. In 2022, with rising inflation and the Fed increasing rates, the market experienced a significant correction. Present day, 2024 to 2025 today, the price-to-book ratio has once again surpassed those highs. However, there are differences from the past, such as the dominant role of tech companies, mass access of retail investors to the market, and dependence on monetary stimulus. The ability to sustain these levels of valuation depends on various factors, including economic growth, corporate earnings, and investor sentiment. A key consideration is whether earnings growth will justify current stock prices or if we are witnessing excessive optimism reminiscent of previous bubbles. Several factors have driven the S&P 500 to this high level in its price-to-book ratio. Multiple expansion. Euphoria around tech stocks and artificial intelligence has led to extremely high valuations. Monetary policy. Despite rate hikes in 2022 to 2023, markets have priced in future rate cuts, encouraging risk asset purchases. Investment flows. With uncertainty in China and Europe, global capital continues to bet heavily on the U.S. market. Increased concentration in a few companies. Currently, a handful of large tech companies dominate the S&P 500, skewing the price-to-book ratio. Optimism around artificial intelligence. AI is expected to revolutionize industries and increase productivity, justifying higher valuations for certain companies. Additionally, some argue that the rise in passive investing and index fund dominance has created an environment where valuations remain elevated for longer periods, as capital continues flowing into stocks regardless of fundamentals. But the big question remains: can the market sustain these valuations without a correction? Historically, when the price-to-book ratio of the S&P 500 reaches these levels, two possible outcomes emerge. Significant correction. If history repeats itself, we could see a major drop in the coming months. This would occur if macroeconomic data deteriorates or if the Federal Reserve maintains a more restrictive policy than expected. A new era of high valuations. Some analysts argue that multiples may remain elevated for longer due to the strength of large tech companies, productivity boosted by AI, and the resilience of the U.S. economy. Market participants will closely monitor corporate earnings, economic data, and Federal Reserve decisions to determine whether this valuation level is sustainable or if a mean reversion is imminent. One of the biggest indicators that the market may be overvalued is the reaction of legendary investors. Warren Buffett, considered the greatest investor of all time, has accumulated a record amount of cash in recent months. Buffett and his team at Berkshire Hathaway have opted to hold more than $150 billion in cash, an amount never seen before in the company's history. This decision reflects his perception that current market valuations are too high to justify significant new purchases. Moreover, Buffett has been clear in his annual letters to investors. He prefers to wait for the right moment rather than rush into an overvalued market. His patience has been key to his most successful investments. If one of the world's most respected investors is choosing to accumulate liquidity instead of deploying capital, it serves as a crucial signal that the market could be nearing a significant adjustment. This conservative strategy suggests that Buffett is anticipating better investment opportunities in the near future, when valuations are more attractive. This raises an important question. Are we at a point in the cycle where caution outweighs the potential for further gains, or is Buffett's approach too conservative given the structural changes in market behavior? If you enjoyed this analysis and want to delve deeper into the current state of the market, I invite you to watch our latest video where we analyze Rivian's recent decline, its sales performance over the last few quarters, and why the outlook looks challenging for the company. Additionally, we will continue to explore macroeconomic trends, sector-specific developments, and investment strategies in future videos. Stay tuned for in-depth breakdowns on how to navigate an increasingly uncertain economic environment and prepare for potential shifts in market cycles.